What's up, traders? Welcome to my YouTube channel. Today we're going to be speaking about the ICT silver bullet strategy. As we all know, ICT has created many strategies before, and this is by far one of the most profitable strategies we have seen, and one of the most simplest strategies we have seen yet to come. Let's dive straight into it. Before we dive straight into it, I just want to let you guys know this is not financial advice, as I am not an authorized financial advisor. This is specifically just for entertainment purposes and for my own learning experience. So let's dive straight into it. So as we all know, there's three kill zones to the strategy. There's the London session kill zone, which is from 3 a.m. to 4 a.m. New York time. We then have the New York AM session, which is from 10 a.m. to 11 a.m. New York time. And then we have the New York PM session, which is from 2 p.m. to 3 p.m. New York time. So what you're going to do is you could use this indicator here. I got it called sessions. This is by, I'll tell you right now. This indicator is by Nephew Sam. You could use this indicator here, and you can adjust the settings to these here. You can use these inputs. As you can see, I got marked out London session, New York session, and I use the Tokyo session for the New York PM session. The London session, which is from 3 a.m. to 4 a.m. New York time. New York AM session, which is from 10 a.m. to 11 a.m. New York time, and the New York PM session, which is from 2 p.m. to 3 p.m. New York time. So you'd have that marked out on your chart, and it would show that you can obviously adjust the colors to your liking. So without further ado, let us jump straight into the entry rules and the criteria in order to take a setup. So first of all, you would have your 2 kill zone sessions over here, and you would jump down to the 1 minute time frame. After jumping down, or you could use the 5 minute time frame, I prefer the 1 minute time frame. So let me show you an example. So basically we'll be waiting for market to be creating a high, higher low, higher high, higher low, and then a higher high, and then we would then wait for the liquidity sweep. Once we get the liquidity sweep over here, which is rule number 2, we will be waiting for a liquidity sweep right over here. Let me just mark this out for you guys. After identifying the liquidity sweep, we're then gonna move on to step 3. Step 3 is basically looking for a displacement or a market structure shift. So basically this would be the next liquidity point, or the next low, which we would then be waiting for market structure to create the displacement, and after creating the displacement we would then be looking for a return to a fair value gap, which is where we're going to be taking our entry point. Let me just mark this out for you all. This would be market structure shift. So after identifying your market structure shift, you would then look for your fair value gap. Before we move on to the fair value gap, you have to identify point number 5 and point number 6. Point number 5 is basically you have to then measure your range. You have to see that from your next entry point till your next liquidity zone, there needs to be a minimum of 10 handles or 10 points. So that would be on your SPX 500. Remember guys, this can be traded on SPX 500 or Euro USD. So on SPX 500, your range needs to be a minimum of 10 points. On Forex Euro USD, your range needs to be a minimum of 20 pips. After identifying your range, you then look for your fair value gap. You mark out your fair value gap. After marking out the fair value gap, you then can look to take your entry. So you set a limit. Stops would go above the previous high, and your target could be the next liquidity zone, or it could be 5 points or 5 handles on SPX 500, or 10 pips on Forex. As you can see here, point number 6, 5 points TP, or 10 pips on Forex. Something, so it would look something like that. Let me show you an example on a buy setup. So you'd basically have your kill zone time. You then basically would identify your market structure, which in this case would be creating lower lows and lower highs. You would then wait for liquidity sweep. After identifying your liquidity sweep, just drag this out, you would then wait for a market structure shift or displacement, whatever you'd call it. After identifying your market structure shift or displacement, you then identify your fair value gap. After identifying your fair value gap, you would then measure your range. So your range needs to be a minimum of 10 handles. So let's just say the next liquidity zone is here. Next liquidity zone. Let's just say a next liquidity zone is there. You would then need a minimum of 10 handles up to your liquidity zone. Basically, it needs to be a minimum of 10 handles. After identifying 10 handles or 20 pips on Forex, you then now can take your entry based off the fair value gap. So you'd set your limit over there, or you could manually enter. Stops below the low. Your target could be 5 points on SPX 500, or 10 pips on Forex, or you could target the next liquidity zone. So without further ado, let us jump straight into live examples of the market, and let's get straight to it. Now I'll show you a trade based off today. So this is the SPX 500, and I'm going to show you all the setup that formed today. As we all can see, this is the today. This was the New York AM session kill zone from 10 AM to 11 AM. And if you want to make it easier, you could always set yours time here at the bottom from UTC, whatever yours is on, to UTC -4, which is the New York time zone, in order to make it easy to identify the kill zone times. So diving straight into it, as we can see, as we'll jump onto the markets a few minutes before the kill zone, we'll wait to see price moving and sweeping liquidity. So like we've got here, you could see price was creating higher highs and higher lows, moving upwards. This price was creating a high, then price was creating a low, and then another higher high, lower low, and over here is where price swept liquidity, entering the kill zone. This was a sweep of liquidity. Let's just type it out there, sweep of liquidity. And now, after our second criteria has been met, which is the sweep of liquidity, and remember guys, we could do this on the 1 minute or the 5 minute time frame. I just find the 1 minute a bit better to do it on, as it provides more setups. So after finding the liquidity sweep, we are now going to be looking for the displacement. As we can see, price came lower and price went higher, and over here price broke and created market structure shift over here. As you all can see that there, this is now a market structure shift. Market structure shift, or MSS as we'd call it in short. After identifying the market structure shift, we will now need to identify our liquidity zone, which this is the most recent liquidity zone. As we can see, this is your next liquidity zone, and this is your final liquidity zone. So now, after identifying the market structure shift, we will then have to identify the FVG that market has left behind, and obviously this would be the FVG that market has left behind. As we can see over here, there's a gap over here after creating the market structure shift, and from that FVG we'll take our ruler tool and measure all the way from there right to the next liquidity sweep and see if the range has been met of 10 handles. As we can see that that entry, that range has not really been 5 handles, 10 handles, so to say. Or we shy maybe like 2 points. But let's say, for example, let's just say you had taken the entry off there. So you would then put your entry at the fair value gap, kept your stop loss above the high, and you could then target 5 points. 5 points would be about here. This would be 5 points. As you can see, price came in, price created the market structure shift, price retraced back into the fair value gap, and price shot straight down, targeting 5 handles. As we can see, that would have been a take profit hit. Let us see if we can find another example. This was the London session. Okay, so we've got London session over here. There's another entry here. So as we can see, price was moving down, created a low high, failed to create a lower low, created a lower high, and then price swept this lower low. This is identified as a liquidity sweep. This should be considered as a liquidity sweep. And let's just mark this out over here. This is the sweep of liquidity. So after identifying your sweep on liquidity, what's the next step? Step will be waiting for a displacement or market structure shift. As you can see, price created a displacement or market structure shift, breaking this high and breaking this high over here. So this already indicates that this is a major displacement, leaving behind a fair value gap. As you can see, there's 1, 2, 3 consecutive bullish candles, and there's a fair value gap being left behind. So after identifying that there, you will then take your tool and you'll mark out your fair value gap. After identifying your fair value gap, you will then measure from this, you will measure your next range. So you would say from here you'd be looking for 5 handles. As we can see, this has not provided us with my bad, you'd be looking for 10 points, 10 handles. As you can see, this has not provided 10 handles, so there was no entry of this here. Let us move on to the session before that. As we can see over here, there has been no entry met. Let us jump to Euro USD and let's see if we can find some examples over there. Okay, so this was today's New York AM session. So we can identify that market has been moving in an uptrend during the session, and while it went, as a kill zone opened, we can identify that this was the liquidity zone. This was the liquidity zone, and we could see price has swept that liquidity zone. After identifying the sweep of liquidity zone, what's the next step? Identifying the displacement of the market structure shift. As we can see, price went up, created a higher high, created a higher low, created a higher high, price came back down, retested on the demand zone and failed to create a lower low, price pulled back, and then price broke the structure, creating a market structure shift or a displacement, as we know. After identifying the displacement or the market structure shift, we then now have to identify our fair value gap. So if we can zoom in here, we can see this small fair value gap that has been left behind from this candle right at the bottom of that candle. As we can see, price has touched it once and twice before shooting lower. So before that, we now have to identify our next liquidity zone in order to see if we can enter this trade based off the 20 pip range. So let us take our measuring tool, and from the fair value gap we will measure. As we can see, this whole range is about 42 pips. 42 pips, so we know we now can enter this trade. So after identifying the range, you can now look forward and setting your limit to the fair value gap, which stops above the previous high. So obviously this would be the previous high, this right here. You can keep your stop loss right above this high, and you can now target 10 pips. So all you have to target is 10 pips, or you could eventually target the next liquidity zone. So let us see. So as you can see, this would be 10 pips would be right about here. This would be 10 pips. This would be a 10 pip range. As we can see, market came back after the displacement into the fair value gap, tapped the fair value gap not once but twice, and then shut down, and it hit your target of 10 pips. Let's see if we can find another setup. This was London session. It looks like there is an entry over here. And remember guys, I'm going to explain to you something quickly. So as we can see, price was moving up, creating a high, creating a lower, creating a low, creating a higher high, creating a higher low, creating a higher high, and price just ranged over here. After ranging, price came and swiped this liquidity. So remember guys, so as I wanted to tell you, you can always have a sweep slightly before your kill zone time, but your entry should always be in the kill zone time. So if market decides to hit a liquidity sweep before the kill zone time, that is always fine. But after the market structure shift and displacement, when it's returning back to the fair value gap and you're looking to enter the trade after all criteria has been met, you should always remember that the entry can only be taken in the kill zone time, not outside of the kill zone time. So here's a very good example of this. As we can see, price came and it took out this previous high, which was a liquidity sweep before the kill zone time, and it then created a market structure shift right here out of the kill zone time, which is totally fine. But then once identifying your fair value gap and your entry, should always remember that your entry should always be within the kill zone time. So as we can see, we've got a fair value gap right here. This is a fair value gap that has been left behind after the market structure shift. And you'd always use the extreme fair value gap. As you can see, there's a fair value gap here, there's a fair value gap there, but we will not use the closest fair value gap, we will use the extreme fair value gap. The fair value gap, that's the last fair value gap. That's the fair value gap we are looking for. So after identifying the liquidity sweep and the market structure shift, we then wait for price to come back and tap into the fair value gap, which should be in the kill zone. As you can see over here, that's what price did. After the kill zone time has opened, price came and shot straight into the fair value gap, moving down to target. But now before that, we first gotta measure our range. As we can see, we've got a low here, we've got a low here. Let us use our measuring tool. So from the fair value gap on Forex, we should have a minimum of 20 pips. I wouldn't really consider this as liquidity zone because this is one complete leg after breaking the structure here. So I'd consider this as the next liquidity zone. So from here, we take our measuring tool and measure all the way down. As we can see, this is 29 pip range. This is a 29 pip range. So now we know we can take this trade. So you would then enter, you would set your limit at the fair value gap. You set the limit at your fair value gap, which stops above the high, and your target could be 10 pips. So you could target 10 pips. As you can see, if you targeted 10 pips, your trade would have hit take profit. If you wanted to, you could have targeted the next liquidity zone for a good 1:2.3 risk to reward ratio. And this happens time and time and again, guys. You'd be surprised. And remember, not every session will there be an entry point, but at least every day on one of the sessions you'll get a decent entry point, whether it's the Forex pair Euro USD or the indice SPX 500. I personally prefer trading the Euro USD pair, but it works just as better on the SPX 500. Let us see if I can find one more example. On this day we didn't have any entry point, and on this day here I see something. Okay, so let's have a look at this one over here. As you can see, price has been moving down, created a low, lower low, lower high, lower low, and then price came and swept right above this previous high over here. As we can see, we've got a liquidity sweep over here. Let me just label it out. We've got a liquidity sweep over here. After that, we can then see price created a market structure shift, which would be this one right over here. This would be considered as a market structure shift. Market structure shift. After identifying the market structure shift, you would then want to measure your range. The range would be 20 pips in Forex. As we can see, we've got a 22 pip range over here. After identifying a range and knowing that all criteria has been met, we would then be looking for our fair value gap. You would then mark out your fair value gap like this. Like I told you guys before, this can happen before the kill zone time, or the sweep and the market structure shift could happen before the kill zone time, but the entry point should always be in the kill zone time. Here's another example. So as we can see, all of this happened before the kill zone time, but the entry happened during the kill zone time. This is why this is so powerful, guys. So as you can see, you would have then entered, kill zone would have opened, you would have then entered on the fair value gap. You would have placed your stop loss right above the previous high, and you could then target 10 pips. 10 pips would be right here. As you can see, this is a good one. 1:1.8 risk to reward. Or you could target your next liquidity zone, which would be down here. This would be your next liquidity zone, guys. So this is how you trade the ICT silver bullet strategy. I hope you guys can learn from this here, and I really appreciate you guys for watching this video. Please do not forget to like, subscribe and share.